Nick, as the co-portfolio manager of the Platinum European Fund, can you tell us a little bit about the history of Platinum, your background and the investment team?
So Platinum was started in 1994 and I joined in 2006, having previously worked at the Reserve Bank of Australia and APRA, which is the banking and insurance regulator here in Australia.
Can you explain how you manage a European equity portfolio from Sydney?
So we travel to Europe regularly to meet companies that we invest in and to visit the countries where we're allocating capital to. We draw on the resources of a large number of global investment banks that have research analysts all over the world. And we also have sector teams at Platinum which focus on specific industries, and we have them all in one place, which greatly helps the process of communicating between the European fund manager and these various sector teams.
What are the investment objectives of the fund?
We look for capital appreciation, which means basically we want to buy companies today that will be more valuable in the future, and we tend to do that with a long-term view.
Your strategy focuses on absolute returns. Can you explain your net equity invested ranges and how and why they change?
So typically in the past we've held anywhere between 10 to 30% of the fund in cash. So as recently as 6 months ago we were very close to 30%, and as the market has fallen over the subsequent 6 months we've found many more investment opportunities and we've put that cash to work. So we're now down at 20% cash, 80% invested.
You manage a concentrated portfolio of around 30 to 70 stocks. Can you explain the stock selection process behind the portfolio?
So Platinum obviously stock pickers. So a lot of it revolves around how do you actually find interesting stocks. We have a few different angles that we approach this from. So number one, we have a quantitative team which focuses on the numbers and tries to abstract from everything else and tries to objectively say, well, here's what the numbers say should be the best idea. We then also have industry teams which follow quite an eclectic process of understanding the bigger macroeconomic headwinds, changes within the industry, changes within individual companies, to try and identify where opportunities might lie, because change always is what brings about these opportunities. And the third thing is market behaviour. So markets go through fads and fashions. So we try and look for industries or sectors which might be out of favour, out of fashion, what we call neglected parts of the market, as opposed to parts which are hot, where investors are congregating. And we prefer to scout for these ideas in the neglected bits. So the idea is to bring all that together, our understanding of the company and the industry, what the hard numbers tell you, and our sense for where the excitement is and where it's not.
Being a European equity strategy, how do you explain the geographic disposition of the strategy?
The countries where the capital is allocated to will primarily be determined by where we find the stock ideas. So it's a very bottom-up, company-specific process. If we're finding lots of ideas in the UK, the fund will have a large allocation to the UK. Currently we have the largest allocations to the UK and to Germany.
Your fund focuses on absolute returns, and you can use short selling as part of your strategy. Can you explain how this reduces market exposure?
Look, you short sell when you think a company is selling at a higher price than what it's worth. Often, the market goes through fads and fashions, and there is excessive optimism in a certain area of the market. Where we can identify this, we try and take advantage of it by short selling. What this does is it protects you against the general fall in the market, or it just allows you to make money when some of the excitement underpinning a particular stock evaporates.
Your strategy can have a broad equity allocation across the European region. Can you explain how you manage currency across the portfolio?
We have a bottom-up process. We begin by choosing the stocks. Having built a portfolio from the stocks up, we then look at it from a big picture level and say, well, where does our currency exposure lie? Are we unhappy with the way it's come out based on our individual stock picks? What we then try and do is smooth it out across a number of currencies to try and manage the risk and reduce that exposure. We also might look at an individual currency position and say, is this higher than we're comfortable with? Perhaps because it's a very crowded currency where a lot of people have a particular view on it, in which case we might try and reduce exposure to that particular currency.
How does the strategy fit into an overall portfolio?
So as an Australian investor, by investing in the European fund, you can get exposure to a number of investment opportunities which aren't available in Australia. So for example, you can invest in global industrials, consumer, healthcare companies. And as a specialised European fund, we can give you a much broader exposure. We can target smaller companies and we can target geographies in Eastern Europe, for example.